Netflix shares have gone down over 23% since its 10-to-1 split November of 2025. And in this video, I want to go through their business model, their moat, their services, what they're offering their customers. Then I want to go into their risks and headwinds, kind of curtailing into what they're doing with this Warner Brothers acquisition and where it stands right now, and if it's good or bad for the company. And then I want to go through their historical financials, their most recent earnings, their metrics, and then wrap it all up with a Simply Wall Street valuation to see what is the fair value analysis looking like for Netflix. So if you like this content, please like and subscribe. I have a free Patreon, a free Substack newsletter, and free X account that you can join for great market insights, great stock analysis insights. So if you like this content, please consider joining those. They really have valuable information for long-term investors. With that, let's get straight into this video. Now, Netflix provides TV series, documentaries, feature films, and mobile games now, more recently, across various genres and languages for an international audience. So a vast network of users and paying subscription members. Now they report their revenue by geography, but also as well as like monetization methods. So subscription versus advertising. And they've recently introduced a lot more advertising into their programming and all throughout their service. I would say that the advertising segment is growing rapidly because they've really instituted advertising and ads everywhere in their service. But their main model is their subscription business. And as they say on their company profile, they say that Netflix is one of the world's leading entertainment services, offering TV series, films, games, and live programming across a wide variety of genres and languages. So it's not just limited to certain, niches of people watching certain things. It spans so many different content and genre that they're really trying to capture everything. Members can play, pause, and resume watching as much as they want, anytime, anywhere, and can change their plans at any time. And their service works everywhere. It can be used on the computer, it can be used on your phone, iPad, and it works seamlessly on the TV, obviously. Just log into your Netflix profile and just watch anywhere on any device. Now, in the US, they have 3 Netflix plans: the standard with ads, standard, and premium. Now, standard with ads, as it states in the name, it's ad supported. All games and most movies and TV shows are available. A lock icon will appear on unavailable titles. Watch on 2 supported devices at a time. It's in 1080p, which is full HD, and you can download on 2 supported devices at any given time. Then you have the standard, which is unlimited ad-free movies, TV shows, and games. You can watch on 2 supported devices, the 1080p again, download on 2 supported devices, and you have the option to add 1 extra member who doesn't live with you. So standard removes the ads and adds 1 extra member who doesn't live with you. So premium is unlimited ad-free content. It supports 4 devices at a time. You can watch in 4K, which is Ultra HD and HDR, and you can download on 6 supported devices, and you have option to add up to 2 members who don't live with you. And there's something called Netflix Spatial Audio, and this is basically available only on the premium plan, and it enhances sound without the need for surround sound speakers or home theater equipment. That's really interesting and a really cool feature. But here are the pricing for each of these tiers. So standard with ads is $8 a month, $7.99 a month. Standard is $17.99 a month, and you can add an extra member for $6.99 a month with ads, or $8.99 a month without ads. And then premium is $24.99 a month. And you can add up to 2 members for $6.99 each a month, and with ads, or $8.99 each without ads. Now, looking at what bulls and bears are saying, the bulls are saying that Netflix has already attracted a massive customer base and level of profitability. This advantage versus competitors makes it more likely a virtuous cycle that can continue, with Netflix securing more content that attracts and holds more subscribers. Netflix is always paying out for original content and creating original content, and that way trying to stay relevant with their existing base of members and subscribers, and continually trying to attract prospective subscribers into their platform. They already have a huge base established, and they're trying to grow that even more into the future. The bulls are also saying that advertising supported subscriptions will open Netflix to a new base of subscribers and a major new source of revenue. Netflix has significant room to grow in international markets where it's already shown promise with local content. And management a little while ago mentioned that they want to turn this into a $1 trillion company. So they really do see a path to that and growing that size market cap. But there's also bear arguments, and the bear arguments are that Netflix faces competition that it has not had to deal with in the past. They are competing with many other forms of content. YouTube for long form content, there's a competition there. And YouTube TV now, Paramount, Skydance. There are several others in the space and also trying to grow their revenues through getting these subscribers. So they're competing fiercely for the same group of customers and based on the type of content. So long form content or short form content, it's all attention. It's all consumer attention. So they're all just competing for attention in the entertainment space. The bears are also saying that Netflix's US business is mature with very high penetration of total households, meaning price increases may need to be a bigger component of future growth. And this is a problem because once a business is mature and has penetrated most markets in a given geographical area, it's harder for them to sustain higher levels of growth and higher levels of earnings. So the only way they can show investors or shareholders greater returns is by increasing the price of their services. And in that way, they're taking their existing base, which can't grow anymore, and getting more money out of their existing base. And finally, the bears are saying that Netflix will need to spend more on content through sports rights and local international investment. So they are going to spend more on content. They're going to have to try to charge their customer bases more if they're already a mature customer base and can't grow that much more. And they're going to face increasing competition in this space. So those are the main bear arguments here. And I would add the Warner Brothers acquisition as also another bear argument to be made, because as we'll get into it right after this segment, they are moving to a all-cash transaction. Acquisition has been kind of a fight between Netflix and Paramount. Both of those companies want to acquire the intellectual property that Warner Brothers has, and eventually Netflix just offered a all-cash transaction of around $82.7 billion, which would be, Warner Brothers at $27.75 per share. And the reason they're doing this is to fight off potential takeover bids, like from Paramount. It's easier to do that from an all-cash transaction, and you can settle it faster, the whole deal faster, if you're doing an all-cash transaction. But what this is going to do, like I mentioned, is going to add a lot of debt on Netflix's side, because they don't have 80+ billion in cash. They're going to have to either raise it from share dilution, or they're going to have to take on debt from some type of underwriter, and it's just going to be worse for their, at least short-term, financials. Okay, so now let's look at their metrics, some of their stats, and go into their historical financials. They are a $363.6 billion market cap. Their EV, enterprise value, is $371.53 billion. Difference between the enterprise value and the market cap is essentially the debt. So if your enterprise value is higher than your market cap, you know that there is that level, that difference, that delta of debt in the company. So if you subtract these roughly, you get a debt around $7-8 billion of debt. And that's what we see here at net debt. Their cash on hand is about $9.06 billion. And inherently, you see the problem with the acquisition of over $80 billion, all cash, of Warner Brothers. They only have $9.06 billion in cash on hand at the moment. So the rest, if they used all this cash up on the balance sheet, would have to be coming from some type of dilution or, debt that needs to get added. And that's a significant amount of debt that they would be adding on to their balance sheet. Shares outstanding, they have 4.2 billion shares outstanding. So this is after their 10-to-1 split late last year. So they really increased the number of shares outstanding. Revenue, 45.18 billion. So they do make a lot of money on the top line. 16,000 employees. Now their trailing 12-month margins are really good. They have 48.5% gross margins. EBITDA at 30.2%, operating margins at 29.5%, pre-tax is 28.2%, net is 24.3%, and free cash flow is at 20.9%. That free cash flow yield is pretty nice. And then looking at their PE, trailing 12-month PE is 34, so kind of high. Price to book is 13.7, EV to sales is 8.2, EV to EBITDA is 27.2. Price to free cash flow is 38.4. But looking at the forward PE, it's 32.6. So slightly lower PE, 32.6. So that could indicate an increase in earnings. And the PEG ratio is coming in at 1.5, which is not bad. The closer it is to 1, the more attractive it is to long-term investors, indicating that it's like getting fairly valued to slightly under 1, which would be undervalued. So this is not bad. This is still pretty good. Like I said, they have 9.06 billion in cash, 7.91 billion in debt, net debt. Their debt to equity is 0.6. Let's go into their financials, the income statement, balance sheet, and cash flow statements. So looking at their total revenues, it's up and to the right. This is nothing to complain here. Revenues have gone up over the past 10 years very significantly. In 2016, they were making 8.8 billion, and now they're making 45 billion plus a year. So looking at their gross profits and margins, you can see that gross profit is tracking up and to the right, and also their gross margins. So they're getting better at minimizing the cost of making that revenue. That's what the gross margins increasing means. They're keeping more of the revenue and spending less relatively on sales to get those revenues. Let's look at other numbers here. Research and development has been going up over time. Their SG&A has been going up over time. I think it's being outpaced by the revenue growth. Operating profit going up, operating margins going up, and now it's close to 30%, which is great. You want to see higher operating margins or EBIT margins because that indicates a level of efficiency that comes from becoming a mature company that can run their operations more efficiently, less waste. And then another thing I like to look for is total shares outstanding. They have a ton of shares after that 10-to-1 split, but they have been doing stock repurchases and they've been bringing this down slowly. They're peaked at around 2020, 4.4, this is split adjusted, 4.428 billion, and now they're sitting at 4.222 billion. So it is coming down. They're doing some share repurchases. I would love to see this go faster, but it is coming down. Now looking at their balance sheet, their cash is around 9 billion, total assets of almost $6 billion. So that's good. Total liabilities, 28.981 billion. That's great to see. So they have double the total assets to total liabilities. That's great, but we have to see what happens. That's why this is so important with this Warner Brothers acquisition, because this could throw it all out of whack based on how much debt they take on. And then they do have a ton of retained earnings. They're sitting on about 42.282 billion in retained earnings. And the retained earnings are super high because of their subscription model, but also they produce original content. So they're probably holding back a lot of money to reinvest into their business, to reinvest into the content that they produce, the original content, to keep subscribers happy, to keep prospective subscribers coming into the door. They have to do this because in this type of entertainment industry, or otherwise they'll become irrelevant and producing things that people don't want. And like I said, all of these companies are just competing for consumer attention. The moment they stop doing that, the moment the revenues and earnings are going to fall. So they have all this retained earnings to reinvest into their business, to their content, and keep people happy and entertained. And finally, their total shareholder equity is about 26.615 billion. The total liabilities and shareholder equity together should equal the total assets. So 55.6 billion, roughly. Going to the cash flow statement, it starts with the net income, obviously. Depreciation, not really anything crazy. It's been going up over time, but it's so small compared to how much revenue they actually make. Share-based compensation, similar story. It's all over the place, really, but it's a small fraction of what they make. Capital expenditures, they have some capital expenditures, but it's not anything close to a company like Alphabet or Microsoft or Amazon. It's nothing close to that. So not really relevant to this analysis. I did say that they are repurchasing common shares every year. So you can see that they did 6 billion in 2023, 6.2 billion in 2024, and 9.127 billion in 2025. Now, this is really important because I want management to see that their company is getting discounted for this, presumably this acquisition, and their shares have been falling. So it would be more attractive to buy more at the current time if I was Netflix management, and I would see the company is undervalued potentially and buy more shares. So it looks like that's what they're doing. They really ramped up their repurchases of common shares from 6.2 to 9.1, and that's the right decision if you believe that the company is undervalued. But we also seeing net issuance go up because of the 10-to-1 split, and also just because they issued more shares. So this really has to balance out. You see the regular free cash flow is positive at 9.461 billion for the last quarter, but then looking at the levered free cash flow and the unlevered free cash flow, they're both negative. And so this indicates that they're spending a lot of money reinvesting back into their business. Now, moving on to the most recent earnings, they delivered $45.2 billion of revenue, which was up 16% year over year, or 17% on a foreign exchange neutral basis, and operating margin of 29.5%, which is up 3 basis points. Now, their ad revenue rose more than 2.5x to over $1.5 billion. Like I said, their ad revenues are going to be growing into the future because they're just pushing out more and more ads, and they're going to do it over a wider base of subscribers if their subscriber base continues to grow, both domestically, but more importantly, internationally. So if we see massive international growth in members and subscribers, they're going to see a huge increase in ad revenue as well, in addition to subscriber revenue. In Q4, their revenue increased 18% year over year, and they crossed over the 325 million paid memberships milestone. Operating income rose 30% year over year. Engagement remains healthy in the second half of 2025. View hours increased 2% year over year, driven by a 9% rise in viewing of branded originals. They're seeing stronger growth in the original content that they're pushing out, which also indicates why they're saving so much money, retained earnings for producing such content. So in 2026, they're focused on improving the core business with the increasing variety and quality of series and films. That's their primary focus. And they're going to enhance the product experience and further growing out the ads business. They're going to build out newer initiatives with live events like the World Baseball Classic in Japan, expanding into more content categories like video podcasts, and scaling our cloud-first game strategy. So a couple of thoughts about that. They're introducing more live events, so they're competing with TV in that fashion. They're going to be competing against YouTube with video podcasts and long-form content like that. And they're also fighting, gaming companies with this game strategy. I'm not sure how successful the game strategy is going to be, but they do face intense competition with all of these things that they're trying to do. Now, they're working to close our acquisition of Warner Brothers, and like I said, I feel strongly that that is going to be at least a short-term headwind for them in terms of their financials. Sustaining healthy growth, we forecast 2026 revenue growth of 50.7 billion to 51.7 billion, which is an increase of 12 to 14% year over year, with ad revenue expected to roughly double and an operating margin of 31.5%. So they forecast their guidance is an increase of 12 to 14% of revenue, and ad revenue expected to roughly double. So they had 1.5 billion and they're expecting approximately 3 billion in 2026. And an operating margin of 31.5%, which should be roughly about 1.5% higher than 2025. This entertainment business remains vibrant and intensely competitive, and we're optimistic about our future. And they summarized the results here in their table. So 12 billion for quarter Q4, 17.6% year-over-year growth. Operating income, EBIT, came in at 2.957 billion, 24.5% operating margin. Net income was 2.419 billion, and the diluted EPS for the past quarter was 56 cents. Free cash flow 1.872 billion, but obviously the levered and unlevered is probably negative because they're reinvesting so much of that. Their shares outstanding 4.317 billion. Okay, so let's move on to the valuation of this company. So I've pulled up Simply Wall Street here. And going to the valuation section, we see that it's based on the cash flows and S&P analysts' free cash flow estimates, that the fair value of Netflix is only $82.93 per share. At the current price of $84.49 as of today, it's still slightly overvalued according to S&P analysts' giving their fair value using the free cash flows. And so how they derived this is using a two-stage free cash flow to equity analysis. They used 11 analyst estimates on average S&P Global. Their discount rate that they used was 9%. They calculated that down below. The perpetual growth rate, 3.3%, which is the 5-year average of a US long-term government bond rate. And here they are relevering the beta, and the beta is entertainment unlevered beta from Oswald's work on valuation. So their discount rate that they finally calculate through all of this is about 8.97%. Using analyst estimates and then the discount rate after that, they get the sum present values of cash flows and then finally create a terminal value and bring that into the present value. Add all that together and divide by the shares outstanding, and they got a $82.93 per share value. Now, a couple of things to note here. This gets even dicier when you consider the Warner Brothers acquisition and some of the other bear arguments like competition, the financial health, the inability, if true, to increase pricing domestically because they've already saturated the market here and not internationally. So all of those things put together gives me a little pause on this company. But this is what the cash flows are saying in a purely math standpoint. So what am I doing with Netflix? I'm putting Netflix on my watch list. I'm going to keep monitoring Netflix price action, see what happens with this Warner Brothers acquisition. If they do go through with it and it isn't hit by regulatory concerns or delays and it goes through, it still adds a significant amount of debt and questions onto Netflix's balance sheet. And it's just some complexity that I'd rather not take on at the current time. But I'm going to keep it on my watch list and see what happens. And if it falls tremendously and they're able to pull out a relatively clean balance sheet after the end of this acquisition, I may look into these shares. But for right now, I'm on the sidelines and I'm not going to add it to the public account. And that's it, guys. If you like this content, please like and subscribe, and I'll see you guys in the next one.